The fuse has just been lit on both ends of the global economy, and the countdown is exactly 15 days. While the Supreme Court just ripped the legal heart out of the Trump tariff strategy, throwing $135 billion in duties into constitutional chaos, the White House has issued a nuclear ultimatum that has two aircraft carrier strike groups, including the USS Abraham Lincoln, currently steaming toward the Persian Gulf. We aren't just looking at market volatility anymore. We are witnessing a total systemic decoupling. Gold is already clawing back at $5,170, and silver is sitting on a short squeeze powder keg at $83 as the Shanghai markets prepare to reopen. If you're waiting for a dip while the world's most sensitive oil artery has an expiration date, you're betting against a math problem that has already been solved. This is not a drill. Today we are breaking down the 15-day window that will redefine everything you think you know about safe haven assets. Monday, February 23rd, New York time. Drop your date in the comments below so I can see exactly where you're watching from. And if this kind of work adds value to your day, hit subscribe and comment the word George Williams. It genuinely helps more than you know. Let's get straight into it because there is a lot to unpack, and every number we're about to talk about is moving as you watch this. Gold is trading at approximately $5,170 per ounce this morning, up more than 1.3% in early session trading, pushing decisively back above the psychologically massive $5,000 level after threatening to break below it last week. Silver is even more fired up, coming in around $80 to $83 per ounce, outperforming gold on a percentage basis and continuing a trend we have been watching build for weeks now. The gold-to-silver ratio has been compressing, sitting near 62 to 63, and that compression tells you something important about what traders believe is coming next. When silver starts closing the gap on gold, it usually means the market is shifting from pure fear buying into something broader, a mix of safe haven demand and the expectation of real economic consequences that hit industrial metals hard. We will get back to that in a moment, because the silver story specifically is where this gets really interesting. But first, let us talk about what actually happened over the last 72 hours, because the setup going into this week is unlike anything we have seen in a while. On Friday, February 20th, the United States Supreme Court dealt a stunning blow to the Trump administration by striking down its use of emergency powers under the International Economic Emergency Powers Act, the IEEPA, to impose sweeping reciprocal tariffs. This ruling did not just create a legal headache, it threw the entire architecture of Trump's trade war strategy into constitutional chaos. The tariffs that had been generating over $135 billion in collected duties were suddenly in legal limbo. More than 1,000 companies immediately began filing for refunds. Trade deals that had been negotiated under the assumption that those tariffs were legally bulletproof, including the landmark deal with India signed on February 2nd that slashed duties on Indian goods from 50% down to 18%, now carry a question mark over their enforceability. The market does not like question marks. Trump responded fast. On Saturday, he announced a new plan, a global flat tariff of 15%, framed as a way to preserve protectionist measures through a different legal mechanism. But here is the thing. Markets do not find comfort in a president announcing a workaround to a Supreme Court ruling within 48 hours. What it signals is that the trade environment is not stabilizing. It is morphing, shifting, and becoming more unpredictable by the week. And unpredictability, especially on a scale that touches every import, every supply chain, every manufacturing cost across dozens of countries simultaneously, is rocket fuel for gold. China still sits under an effective tariff burden of around 47.5%, with more than 70% of its tariff lines attracting duties as high as 55%. The India deal gave New Delhi a massive competitive advantage over Beijing, and in response, Chinese investors have been pivoting heavily into gold as a hedge against economic isolation. Local gold ETF inflows in China in early February were outpacing those in the United States. The People's Bank of China has been adding to reserves for 3 consecutive years at over 1,200 tons annually. So you have Chinese institutional money, Chinese retail money, and Chinese central bank money all flowing into the same metal at the same time. That is not a small footnote. That is a structural floor underneath the price. Now layer the second crisis on top of that, and you start to understand why gold and silver jumped together this morning. On Thursday, February 19th, President Trump gave Iran a deadline that shook the entire Middle East. Standing before the newly formed Board of Peace at the White House, ironically, a peace initiative, Trump told reporters aboard Air Force One, and I am quoting directly here, "We're either going to get a deal or it's going to be unfortunate for them." He put the window at 10, 15 days, pretty much maximum. Iran must come to the table, agree to full nuclear restrictions including zero enrichment, give up its long-range ballistic missiles, stop supporting proxy groups across the region, and stop using force against its own protesters. Iran's response was to call it a real risk of military aggression and threaten retaliation against U.S. bases across the Middle East. This is not background noise. The United States has been amassing one of its largest military buildups in the Middle East in years. Satellite imagery confirmed a significant concentration of naval and air assets near Iran, destroyers, attack aircraft, and at least one carrier strike group already in position, with a second reportedly en route. Defense officials said the full military deployment would be in place by this past weekend. That means right now, as you watch this, the hardware is there. The USS Abraham Lincoln Carrier Strike Group has moved into position. The clock is ticking, and the unofficial deadline window runs from approximately March 5th to March 10th, with nuclear talks in Geneva scheduled to resume on February 26th. Experts are not optimistic about a peaceful resolution. Jason Brodsky, policy director at United Against Nuclear Iran, told Fox News Digital that he sees deep skepticism in the Trump administration that this negotiation is going to produce any acceptable outcome. He described Iran's core positions as unchanged. They refuse zero enrichment, they refuse to dismantle nuclear infrastructure, they refuse missile limitations, and they refuse to end support for terror groups. The diplomacy may actually be serving a dual purpose, sharpening Iran's choices while simultaneously buying time to ensure U.S. military assets are fully staged and ready. Meanwhile, Iran's Supreme Leader Khamenei publicly rejected Trump's conditions on February 17th and suggested the U.S. Navy can be sunk. That is not the language of a government preparing to sign a deal. That is the language of a government preparing for something very different. So here is what markets are computing in real time. You have a tariff system that has just been declared legally questionable by the highest court in the land, creating fiscal uncertainty, dollar weakness, and trade chaos. And simultaneously, you have a countdown clock running toward a potential military confrontation involving the world's most strategically sensitive waterway, the Strait of Hormuz, through which approximately 20% of the world's oil supply flows every single day. If that strait gets disrupted, even briefly, the ripple effects through energy markets, shipping costs, inflation expectations, and safe haven demand would be seismic. Goldman Sachs has reiterated its gold price target for year-end 2026 at $5,400 per ounce. Wells Fargo Investment Institute is forecasting $6,100 to $6,300 by year-end. The World Gold Council expects a 5% to 15% gain for gold this year, and technically, gold's decisive reclaim of the $5,000 psychological level is a very clear signal. Action Forex analysts are pointing to $5,270 as the next near-term target, with $5,530 coming into view if geopolitical escalation continues. Now let's talk about silver specifically, because this is where your forward-looking analysis needs to live. Silver right now is playing a dual role that makes it uniquely powerful and uniquely volatile. On one hand, it is a safe haven metal, moving in lockstep with gold when fear is in the air. And right now, fear is very much in the air. On the other hand, silver is an industrial metal. It is used in solar panels, semiconductors, electric vehicle components, medical equipment, and a wide range of high-technology manufacturing. That industrial role means silver's price is also sensitive to global growth expectations. And if the tariff war causes a genuine slowdown in manufacturing output, silver can face downward pressure from the demand side, even while geopolitical fear pushes it upward from the safe haven side. This tension is exactly what you need to understand before making any decisions about the metal. But here is what tilts the balance right now toward the upside for silver. The silver market has been in a structural supply deficit for 6 consecutive years. Above-ground stocks have been steadily depleting. Earlier in the tariff crisis, we saw silver physically vacuumed out of exchanges to be stockpiled in American vaults, with lease rates temporarily spiking to more than 30 times normal levels during periods of acute stress. That kind of physical market behavior does not happen in a healthy, well-supplied market. It happens when the metal is genuinely scarce. Silver already broke above $50 per ounce in late 2025, a level that had been a ceiling for decades, and pushed toward its nominal all-time high of $121.67, set on January 29th of this year. It has since corrected and is consolidating around the $80 to $83 range. Technically, analysts are watching $94 as the next meaningful upside target, with resistance near the $100 psychological level. A clean break above $100 on sustained geopolitical and monetary pressure could open the door to a retest of January's record highs. Here is how to think about the three scenarios playing out over the next 2 to 3 weeks. Scenario 1. Iran and the US reach some form of preliminary agreement before the deadline expires. Diplomacy wins, even if it is a thin, framework-level deal. In this case, gold and silver would likely see a short-term pullback, profit-taking, relief selling. But the structural drivers remain intact. The tariff chaos is still there. Central bank buying is still there. The supply deficit in silver is still there. Any dip in this scenario would likely be viewed by institutional buyers as a buying opportunity rather than the beginning of a reversal. Scenario 2. The deadline passes without a deal, talks collapse, and the US carries out limited military strikes on Iranian nuclear facilities, similar in scope to what Israel executed in June 2025. In this scenario, gold could push aggressively toward $5,530 and beyond. Silver would initially spike sharply on the safe haven bid, potentially retesting $100, before facing industrial demand uncertainty if the conflict threatens global supply chains more broadly. Oil would spike, which adds inflationary pressure, which is further fuel for precious metals. This scenario is the one that most analysts consider increasingly likely, given the posture of both sides. Scenario 3. Full escalation. The scenario nobody wants to speak out loud, but that markets are quietly beginning to price. If military action triggers broader regional conflict, if the Strait of Hormuz is threatened, if oil supply is genuinely disrupted, precious metals go into a different gear entirely. That is not a forecast, that is a tail risk. But the fact that the tail risk now has a visible countdown clock attached to it is exactly why gold and silver are where they are this Monday morning. What you are witnessing right now is the market beginning to compress two of the most powerful forces that drive precious metals: geopolitical war risk and monetary/trade system instability into the same narrow window of time. These forces rarely arrive simultaneously. When they do, the price response in gold and silver historically overshoots in ways that leave observers scrambling to explain it after the fact. The gold-to-silver ratio at 62 to 63 still has room to compress further if silver catches additional industrial bid once Chinese manufacturing demand re-enters the market fully after the Lunar New Year holiday. That re-entry is happening this week, and physical demand from China is adding incremental support to a market that was already tight. The next 10 days are not just a political timeline, they are a market-moving countdown. Keep your eyes on February 26th. That is when nuclear talks in Geneva are scheduled to resume. Keep your eyes on early March, when the military window closes. And keep your eyes on the $5,270 level in gold and the $94 to $100 zone in silver, because those are the technical lines that tell you what the market has decided to believe. The clock is running. The metals know it. The question is whether you are paying attention before the move happens, or explaining it to yourself afterward. Stay sharp out there. These markets will not wait.